Hi there, thank you for joining us today in the newest video. Today we are going to discuss the weighted average cost of capital, or in other terms, Wacc. Wacc is used to discount a future value of a company in today's money. The formula of the Wacc looks like this, which might seem in first eye a little bit complicated. So let's break it down in pieces. The Wacc is the opportunity cost of capital, RE, times the ratio of equity to value of the company, plus the cost of debt, RD, times the tax shield, 1 minus T, times the ratio of debt to value. Well, opportunity cost of capital is then split out in the risk-free rate, which, as a small recap, is the yield on a totally risk-free investment, such as a government bond, plus the beta of the company times the market rate. Then the cost of debt is basically the interest rate you pay on your debt, or if you don't have the rate, it's the total interest paid divided by the total debt. Value is debt plus equity. Well, to construct it and to see the logic behind it, let's go to Excel. Okay, so here we are again, the same formula as here in Excel. Let's start by the beginning. Let's imagine a firm with no debt at all. Then his cost of capital, the discount rate, or how you would call it, is just the cost of capital, right? Let's try to get it in the equation. The cost of capital, right? Because the equity to value is 100% own money. So this would be 0 divided by the total value. 0 times something, well, that's 0. So this whole part of debt falls away. Well, now imagine that the company has indeed some debt. First, you might say, okay, so it's the normal cost of capital, like we have here, plus the cost of debt, and maybe we want to divide it by 2, and then you have your average cost of capital. And to a certain point, that's indeed correct, but that's not the whole picture. Because some companies might only have 10% debt, and other companies might have 90% debt. And as the cost of debt is so different than the cost of equity, well, we must weigh it. Well, we weigh it by adding the ratio, which is, of course, equity to value and debt to value. You see, we're slightly getting there. But also, in most countries, if not all countries, debt is deductible by tax. So we have to incorporate a tax shield. So that's why we do 1 minus the tax rate in the debt part of the equation. So that's basically the formula. So how do we apply that? Let's go to the first example. So Omega Corporation has 11.6 million shares outstanding, which are now trading at $49 a share. Moreover, the firm has estimated that the expected rate of return to shareholders is about 11%, and it has also issued long-term bonds, so that's more than 10 years, at an interest rate of 8%. Well, it pays tax at the marginal rate of 35%. And finally, assume a 170 million debt issuance. So typically, two questions are: what is the after-tax weighted average cost of capital, and how much higher would it be if there would be no debt at all? So let's start with the beginning. We have the total equity, which is simply the number of shares outstanding, million, times the price of the share per share. Let's put a dollar sign, plus 49. So that is $568,400,000. Next to the equity, we have the debt. The debt, as it's stated here, is 170 million, so that's easy. Right? So the total value is the debt plus the equity, which is together 738 million. Okay? Okay. So now, what I always like to do is now to calculate the ratios already. So we have the E equity divided by total value, which is equity divided by total value, which is 0.76, and we have the debt to value ratio, which is 170 divided by this is 0.23. So let's go to construct the final formula then. We use the cost of capital, which is the expected rate of return to the shareholders, is 11%. We multiply by the equity to value ratio, right here. Then we add the cost of debt, which is mentioned here, 8%. We multiply it by the debt to value ratio, and we multiply it by the tax shield, which is 1 minus 35%. Which means our weighted average cost of capital is 9.6%. So for question B, the cost of capital multiplied by the ratio equity to value plus the long-term bond rate times the debt to value, which is roughly 10.3%. Let's say if there was a question C, if there was no debt at all, so 100% equity financed, then the Wacc would simply be the cost of capital. You see, so the more debt there is, and the more debt there will be used, the cost of capital will be lower. Logical, because the cost of debt, which is 8%, is lower than the cost of capital, which is 11%. Alright, so let's go to another example. Here we have a company that has, again, a marginal tax rate of 35%, the cost of equity is 12%, and the pre-tax cost of debt is 6%. So what would be the tax-adjusted WACC, which is basically the same as the after-tax WACC? Again, I always find it more easy to mention all the data again. So the equity to value is basically equity 26.2 divided by the total value 32.9. Let's make a formula out of that. Well, our debt to value is 6.7 divided by the total liabilities. Alright, so let's start with constructing the whole formula again. So we have the cost of equity, which is 12% times the equity to value ratio plus the cost of debt, 6%, times debt to value ratio times the tax yield results in a WACC of 10.35%. Right? Let's go to yet another example. So we have here that we want to estimate the weighted average cost of capital for a new airline business. Based on the industry asset beta, we have already estimated that the unlevered cost of capital for the firm is 9%. However, the new business will be 25% debt financed, and you anticipate its debt cost of capital will be 6%. Well, the corporate tax rate is 40%, so what's our estimate for the WACC? So, let's start again by the beginning. We have an unlevered cost of capital, so we have to make it levered again. So, let's put down what we know. We know that the unlevered cost of capital is 9%. We know that that is 25%. We know that the equity is 75%. Let's make it to value. And we know that our cost of debt is 6%. Alright. So, if we forget about the tax, it's basically what's standing here is what we do. So basically, if we forget about the tax for a moment, it's 9% is equal to what we really want to know times the equity to value plus cost of debt times the debt to value. Oops. Right? Well, this formula we can alter it to get to our what we want to know, cost of capital. And so we move the 6% times 25% to the left, and we divided both sides by 75%, and we have our value what we want. So it will result in 9%. We move it to the left side, so it will be minus. Oh, that's 0 too much. 25% times 6% divided by 75%, which is 10%. And now we can do the complete calculation again, but now for the Wacc, which is again 10% times 75% plus 6% times 25% times our tax shield, which was 40%. This will result in a Wacc of 8.4%. Still with me? Then we go to our next example. Here we have Unilever Systems, which has 40 million shares, which are at the moment trading for $10 a share. In addition, Unilever has 100 million debt outstanding. Well, let's suppose for now that the equity cost of capital is 15% and the debt cost of capital 8%. And again, a tax rate of 40%. So we have now three questions. What's the unlevered cost of capital? What's the after-tax debt cost of capital? And what's the weighted average cost of capital? Well, we will start again by the beginning. So we will start again by the beginning. What is our equity? Our equity is 40 million shares times $10 a share. Let's make a formula out of it, which is 400 million. Alright? Our debt, we also know. It's a 100 million. We know our cost of capital, which is 15. We know our cost of debt, which is 8%, and we know our tax rate, which is 40%. So then we know that our equity to value is simply 400 million divided by 500 million, which is 4 plus 5. And our debt to value is then 0.2. Agreed? Let's go here. From the beginning. The unlevered cost of capital is then 15% times the equity to value plus 8% times the debt to value, which is 13.6%. So, the after-tax debt cost of capital is nothing less than to include the specific tax shield. So we have our cost of debt times the tax shield. 1 minus 40% is 4.8%. Now we can calculate the Wacc, and the Wacc is simply our %15 cost of capital times the equity to value ratio plus our after-tax cost of debt times the debt to value ratio, which result in a Wacc of 12.9%. Well, good. Now you might think, okay, all nice that you have all those numbers and stuff, but where do we go from the beginning? Well, let's go to our last example. Basically know all the data, all the information we have to know. We have to know the beta, we have to know the risk-free rate, we have to know the market rate, we have to know the value market capitalization of the company, we have to know the total debt, we have to know the cost of debt, and we have to know our tax. So I already searched for some third-party resources to find the data quickly. Let's get started. So first for our beta. Many financial websites, Reuters, Bloomberg, Yahoo Finance, Capital IQ, S&P, you name it, most of them, they report for every kind of stock their beta. So here, if we go down to our overall information, for Unilever, by the way, we see a beta of 0.96. So let's get back to Excel and let's fill it in. So we also want to know the risk-free rate. For this, well, we could find it on the Reuters website as well. However, sometimes it's easier to find those things on the website of a newspaper. So we have here, Unilever is a Dutch company, traded in, amongst others, in Amsterdam. So we take the 10-year government bond of the Netherlands, which is at the moment a risk-free rate of, well, very low, 0.507%. Let's get back to Excel. So 0.507%. Then we want to know our the market risk premium, and I have it here from the consultancy firm KPMG. They researched all equity risk premiums, and they found out that as of the 30th of June this year, the risk premium is 5.75%. So let's put it here. Well, our market cap, I have here a link of Yahoo Finance, but we have it here. The market cap in millions, 146 and something, which is basically 146 billion. Let's put it here, 146 billion. So for our total debt, we go to Yahoo Finance, same company, Unilever again, and we have it on their balance sheet here. Their total debt 39 billion, so 39.449 billion. So their cost of debt, like I said, is the interest rate or the total interest paid divided by the total debt. So let's go back to Yahoo. We have here also the income statement. In the income statement we find the interest expense, which is 572. So let's go back to Excel. 572 divided by the 39,449 total debt, which is a cost of debt of roughly 1.5%. Well, for taxes, the corporate tax in the Netherlands, it's in brackets. For the first $200,000 of profit, it's 20%, and all the profits above 200,000 is 25%. We can see it here on this website of KPMG. Again, if it opens, yep. We search here the Netherlands. We see 25%, but we see, right, 20% for up to 200,000 and 25 for everything above. So we know that from our calculation we must be somewhere between the 20 and the 25%. Let's see if we can work it out. So that's their, that's their income tax expense divided by the earnings before interest. So 1922 divided by 777. 19. And as we see, it's 24.9%. Which should be more or less correct. Well, from here, let's first start with the cost of capital. Remember, our cost of capital was the risk-free rate plus the beta times the market rate or risk premium, equity premium. So that's our risk-free plus the beta times the market. A little mistake there. Okay. Well, we know that the cost of debt is 1.45%. Well, we have our equity, we have our debt, so we have our equity to value is, or let's first start with the value, is 146 plus the 39, so equity to value is and that value is then 1 minus that, and then we can compile the whole Wacc again. So we have our cost of capital times our equity to value plus our cost of debt times the debt to value times our tax shield, which is 1 minus the 24 something percent. Here we see the weighted average cost of capital for Unilever is 4.9, almost 5%. Well, and that's how we calculate the weighted average cost of capital. Thank you for watching this video. I hope you liked it. I hope you enjoyed it. I hope you learned something. Please subscribe, drop me an email, like, comment, share, etc. Have a nice day and talk to you next time. Bye bye.